morning, everyone, or good afternoon, everyone. This is Tim Coons with Noak and Company. I'd like to invite you to our seminar. During this webinar, we will be a few simple rules. First of all, make your screen full screen. It'll help you view the entire screen. Second, if you look at the bottom, we've got a couple controls down there. There's a Q&A section. If you use that Q&A section, I will be watching it, and I'll either answer your questions directly or I will forward on to Howard and Janet for answering your questions. You also see a chat section down there. I'd recommend you use the Q&A and not the chat section. The chat section we're using to communicate with each other on the back side of it. We will not be answering them directly. We can follow it up after the presentation. So if there are any questions from this point forward, just stick them in the Q&A. If not, I'll hand it over to Janet and Howard and do your magic.
Okay, good afternoon, everybody. As all of you know, we have been doing a lot of webinars on the disaster relief, and so we thought it was appropriate to segue into the questions that our clients are asking us now, which is how they recover from the market volatility that has happened in the last couple of months. So we work very closely with Howard Jordan and his team, and they're with Raymond James at the High Net Worth Advisory Services section. Between us, we have a lot of common clients, and the reason we have those clients is because over the years when I've had the CPA firm, I've always watched who's successful and who's doing well in the market. And what I have seen with Howard and his team is that they always have the highest consistent returns of the other advisors that I see, and they have the best customer satisfaction. So we always are watching for people that treat their clients right, just like we do with our clients. So when our clients started to turn to us and got upset, I couldn't help but think that when the market took a downturn, Howard reached out to me. I didn't have to reach out to him, and he helped us to rebalance our portfolio. And it's very interesting because right now we are back above where we were before the market crash, and actually segments of our holdings are now up over 8% that we had switched to after the market crashed. So we feel like Howard and his team have consistently done a great job for us. So we would like to give Howard an opportunity to talk to you about how they do such a great job for their clients, because they consistently outperform the other advisors that we see. So Howard, if you want to take it from here, I'm going to let you talk, and then I'm sure I will jump in and ask you some questions.
Wonderful. Janet, thanks. Tim, thank you. We really appreciate the opportunity to be in front of some of your great clients, and hopefully some of ours are on here as well. This is obviously a really difficult time for a lot of people out there. And what we want to do is make sure that we're being proactive instead of reactive. A lot of financial advisors during stressful times in the market, they sit back and they wait for their phones to ring. They wait for their clients to communicate with them. We're a little different. We make sure that we're staying on top during this difficult time, challenging time, to make sure that you're hearing one of our team members on a very regular basis. So what I want to kind of start out with is right now, and again, Tim and Janet, your situation is going to be completely different than anybody else that we're talking to. So when we talk about different stocks or different sectors, this is not a blanket recommendation for anybody to do anything. We just simply want to tell you what we're doing with some of our clients, and it all boils down to risk. So right now, we think this is a very interesting time in the market where being in the right stocks is just as important as being in stocks. And we're going to go through some slides later on in the presentation that will bring up exactly what we're talking about. So when we take a look and we go back to when all this started in the beginning of February, and then kind of that has slid through, and now we're in June, on March 23rd, 2020, that may be a date where everybody looks back and says, what were you doing with your portfolio during that period of time? Since that period of time, we've seen the market jump about 40%. So we hit those lows on the 23rd of March, and now we've been back up. So we're really seeing two different types of things happening. We're seeing people that say, I'm down, I've lost money. And then we have people that say, I have this fear of missing out. I'm missing out on some opportunity. So again, later in this presentation, we're going to talk about some specific opportunities. They're not opportunities for you individually because we don't know enough about you to make blanket recommendations. So what's going on in the world today? Obviously, there's a lot of negativity. There's a lot of uncertainty. There's a lot of people without jobs. So what the stock market and the bond market is trying to accomplish right now is trying to figure out where we are. Are we going to retest some of those lows that we saw in March? Or are we full steam ahead and we're going to move forward? And I can tell you right now that nobody knows that answer. But you have to take a look at your portfolio and understand what's in it. We have said for a long time during when this first started, don't touch your face and don't touch your stocks. Now, for the first 90 days, that worked out pretty good. And none of our clients hopefully didn't touch their face, but very few of them touched their stocks. Well, now as we move into phase 2 here, we're saying now maybe it's time to take a look at your stock holdings. Because during periods like this, what our group does and our team, we look for quality, we look for ways to improve your portfolio. So one of the things that we've said since we've been in the business, and just to give you a little context on that, I've been doing this for 26 years. And my partner, Dave, who's not on this call, he's been doing it for 35 years. So we have a lot of experience going through some really difficult and challenging markets. And one of the things that we focus on is making sure our clients understand what they own and why they own it. So your investments, and a lot of you have just collected things over the years, it's not just looking at your statement once a month and looking at the value and saying, it's higher, great, they must be doing a good job, or it's lower, they must be doing a bad job. It's important that every line item that you see on your statement, that you understand exactly what you're investing in. And it boils down to risk. How much risk are you willing to take, or how much risk are you willing not to take? And important as it is in the stock market, where we really see a disconnect for people is when they look at their fixed income investments. Most people have no clue the risk involved in some of their fixed income investments. So don't just take this conversation as what should we do with stocks. There are ways that you can upgrade your portfolio if you're heavily weighted in a fixed income portfolio. Again, this might sound like a broken record from time to time, but every individual that we deal with, every family that we deal with, their risk profile is completely different. So we just want to make sure that even though we're going to go through a lot this afternoon, that everybody understands that you are unique and you need a unique plan to get you to where you want to go. Carl, if you want to kind of flip through the next couple slides for me. Go to the retail investing slide if you don't mind. So this is a really good illustration of investment returns over long periods of time. So when you take a look at everything on the right in the dark blue, that's where public funds, pension funds, endowments, that's their annualized return. When you take a look at the far left, that's the average investor's return. It's typically lower. And the reason that it's lower is, again, we see a lot of people doing the wrong thing at the wrong time. So what you can't do is panic when things start moving against you, and you can't get too excited when the market's moving forward. So if we take a look at where we are today, we're kind of in that struggle, right? We have people that believe that this market's going to take off, and then we have people that believe this market's going to head right back to those 18,000 Dow points that we saw in early March. So the takeaway from a slide like this is you have to be invested for longer periods of time. You can't let emotions mix into what you're trying to do. You need to have a solid plan and you need to follow through with it. And Janet, I know one of the things that you want to do is kind of bring this down to where maybe what we do and have these conversations with you and Tim.
Right. So Howard, if you'll recall, when the market started to, well, after it crashed, you and I had chatted, and I had suggested maybe that we take some of our holdings that were in bond funds, et cetera, that didn't go down very far, and take some risks. And I asked you what sectors you believed might be good investments at that point. And it has played out really well for us. So I was hoping maybe you could talk a little bit about what sectors you believed, because you brought up 4 or 5 sectors to me that you thought were worth taking a look at, not necessarily investing in, but taking a look at.
Carl, if we could pull up the one slide that talks about the different companies. And again, when we take a look at this list, I want everyone that's paying attention today to understand that these are not individual recommendations for you. It just puts a good context into exactly what's happened recently in the markets. And you're going to be surprised at how quickly and how far some of these individual stocks have fallen. So if you think about it, where is the world, where's Wall Street right now? And where do people think that a lot of damage has occurred? So this screen, and I'm going to point to a couple names. Right now, cruise lines are one sector that have gotten beaten up. And if you look at this, you're going to see Carnival Cruise Line, which is the fourth stock that's listed on this sheet. CCL is the symbol. And you can see where it ended. This is as of May 20th. The stock was around $14 a share. Well, at the beginning of the year, the stock was $72 a share. So in this sector, in this example, back in February and January, the world believed that people were going to continue to get on cruises, enjoy themselves, and spend money doing that on their leisure time. Fast forward to March 23rd, when the stock went down to $7 or $8, the world basically said no one's ever going to step foot on a cruise ship again. So when we talk about opportunities, we want to take a look at some of these high quality companies and how they've traded off of their highs, and maybe not necessarily the individual stocks, because there's many different ways that you can invest in these types of investments. And if we go down the list here, you're going to see Delta Airlines down 64%. You're going to see some of the hotels, Las Vegas Sands down 62%, the Marriott down 40%. You're going to see some of the car driving services, Lyft and Uber, down 30 and 65%. So when people are looking at, are there opportunities out there? How do we take advantage if we believe that this market is going to rebound and people are going to, at some point, re-enter the economy and do business with some of these companies? Now, obviously, for some people, they can take the risk of owning individual stocks. Others can't, or others won't, and that's fine. But there are ways to participate in stocks like this in numerous ways. But I think to your point, Janet, we kind of singled out a couple companies. You and Tim, we had a great conversation, and you both said, well, this is the airline we fly. These are the hotels that we like to stay at. And those are really good ways to judge what types of companies could come back.
Howard, when we had discussed, you had also given us some sectors that you believed were going to be hard hit for a long time. And let me actually back up. We did focus on the hospitality industry because, for those of you that know me, my family's history and my life is focused in hospitality. Even though I do this CPA thing now, my whole history has been hospitality. So I know that market really well. But you had made some recommendations of other industries you believed were going to come back in a strong way. What are those?
So when we take a look at other industries that we would favor moving forward over the next 12 to 24 months, healthcare, technology, what we've seen, again, we've seen this struggle between stocks that have done terribly and stocks that have actually done pretty well. So companies like Amazon. Now, everyone out there may say, well, we've used Amazon before. It's not a new company, but how many people out there have used Amazon more over the past 90 days than maybe you did the 90 days previous? This whole work at home concept, we believe that it does have traction. Now, it won't be for everybody, but we do believe that there'll be a large percentage of people that will be working from home. So what companies will do well in that environment? Companies like Microsoft, companies like Salesforce, companies like Google. These are companies that will do well if we are in a period of a lot of people working at home. And then on the healthcare side, it seems like every week there's a new company that comes out. Some of them are well established and they have success dealing with the coronavirus. And those stocks are all over the place. So that's an area that we would take a look at, maybe owning an exchange traded fund or a mutual fund. So you're getting that diversification of a lot of these leading companies. Think about what's going to happen on a regulatory standpoint and what we're seeing happen in a lot of these drug companies. So where it would take years and a lot of red tape and a lot of government assistance to pass along some of these drugs, now we're seeing it happening in warp time. So we're hoping things like that continue. And a lot of the biotechs and big healthcare companies we think are worth owning at these levels.
Okay, so likewise, we had talked about a couple of industries that we believed would be bad investments at this point. Can you tell me some industries that if you had a client that was invested in them, you might recommend that they reallocate their portfolio?
Sure. So if you take a look at what could struggle, you're looking at some of the banks, some of the financial companies. So they're getting hit on all ends, right? Interest rates are at all-time lows, and they are going to have some debt out there and some loans that they've made over the past 12 months that are probably people are going to struggle to pay back, whether it's a home loan, whether it's car loans, whether it's home equity loans. So the banking sector, not all of them, but there are some. If you're going to own them, we are focusing on the ones with the cleanest balance sheets. We've seen oil. We've seen a lot of these energy and utility stocks over the past 90 days have traded all over the board. Again, oil, the consumption of oil with everyone staying home, with discretionary spending almost halted. We've seen some of those energy stocks down 50, 60, 70%. So again, we're not saying that you need to avoid all of them, but it gets back to our recommendation and our advice is you better understand what you own and why you own it. So the difference between owning an ExxonMobil and a Chevron and some of the smaller refineries is huge. You just want to make sure you have the ones with the cleanest balance sheets.
Can you talk a little bit to the balance sheet issue there, Howard? Because that's critically important right now.
And Janet, before you jump in, I did have one question might be relevant to that. I've got one person says, hey, with this time off, they've been spending a lot of time at home and they've been watching the stock market. They never have really done that in the past. They've always just trusted their advisor. Can you maybe, how would somebody like Howard invite them in to be involved and take more of a proactive involvement in their stock portfolio?
So that's a great question, Tim. And you're right. A lot of people have a lot more time on their hands. So again, it gets back to, I think people hopefully are taking this time to really understand what they own. The difficult part is when you look at your statement and you see I own XYZ blue chip fund, you're putting a lot of faith in somebody that's making that decision for you. So what we do is we make sure that the fees are competitive, that the risk is what you expect it to be, the returns are what they expect it to be, and a lot of times they produce income. We want to make sure that the income is stable. So what we would expect after major shocks to the system like this is we would think that we're going to start to see some dividend reductions. So we want to make sure again that even though that you own a mutual fund, it's very difficult to understand exactly how that works for you. So we want to make sure that the dividends are intact. And what's more important to us are companies that increase their dividend instead of searching for the highest dividend. And that's a big mistake that we see investors do. They just try to get the most yield possible. And in a lot of cases, you don't understand the risk you're taking to secure that yield. So again, you just want to really make sure that you understand everything that you own. And trust me, I've been doing this long enough. It's not easy in every case. There's a lot of investments out there, a lot of securities that people have collected over years. And maybe some of you online today are exactly that person. Over your lifetime, you had a relationship with somebody and you collected X investment. And you went and picked up some ExxonMobil. Then you picked up this mutual fund. Then you bought an annuity. Then you bought some life insurance. And if you really don't have somebody to coordinate that, to show you exactly why you own those things, you're just collecting. You're not a true investor. And I think this is a perfect time, with so much time on our hands, to clean things up.
Can you go back to one? We'll go to that question in 1 minute. I just don't want to lose it. Can you address the importance of the balance sheet in anything anybody invests in today? I know I could, but I know you know it better than me in the investing world. So can you take that question?
Yeah, so when you take a look at, and I hate to keep picking on a lot of the energy and the oil companies, but they take on a lot of debt. And when oil prices are a certain level, things work out pretty well for the energy companies. Well, what we've seen in the month, May, we had a nice comeback, but in March and April, when we saw the price of oil continuously go lower, that puts a lot of stress and challenges on a lot of these companies that borrow a lot of money. So what we do is we make sure that any individual equity or any of a closed-end fund or an exchange-traded fund, we want to make sure that we understand the leverage that each one of these investments or securities is taking. And again, it's a little bit more time-consuming, but it's important to understand how much risk, how much money they're borrowing, what the covenants are of those loans, and will the investor eventually get paid back? And in some cases, they won't be. And you're seeing some of these companies locally here. We're looking at Hertz out of business. We're looking at a lot of the, or declaring bankruptcy, maybe they reorganize. JCPenney, you're starting to see companies like that come online and saying we can no longer do business. So we want to make sure if we own those companies that we understand the risk and we're willing to take that risk. So again, it's all about, are we going to get our money back? If we loan our money and buy a corporate bond in Chevron, does Chevron have the ability to pay us back interest and then our principal back? If we get nervous about that, then we don't want to own that security.
Yes, I got a question that came up here that said, I got a PPP loan. I've got some cash. My company is still in business, but I'm still a little nervous. When's the right time, or should I be making any changes in my personal investment that if I have to fund my company, what should I be doing with that?
So Tim, that brings up, one of the things that we require when we meet with someone for the first time. We need to understand your cash flow. We need to understand how much does it cost you to turn your lights on and live your life for a year, for 2 years, for 3 years. And depending on your risk tolerance, we want to make sure that that money is set aside. So no matter what happens to the market, you always have that money in reserve. Of course, now the challenge is, what do you do with that cash? Because right now, interest rates on money markets and CDs are at all-time lows. So you almost have to understand that for cash reserve money, you're going to earn nothing or very little. And that's okay, because you have to understand that you need to have some money in cash in the event that this lingers, gets worse, and we're looking at this situation for many, many months in the future. I'm a little reluctant for people that say we received this money in the PPP. And again, Janet can talk a lot more about how to follow those rules, about taking that money and saying, I can now invest this in risk assets. That could be dangerous. Now, is it impossible? No. But again, we just really have to understand exactly what's going on in your financial life to make those types of recommendations.
Howard, a lot of the people that did get the PPP money, they had some other reserves. And I think they're starting to think about the economy might not really crash in their business until September, October, November. It might be delayed. So they're thinking about how they can actually get a little bit of growth on that money between now and then. And I think my answer to them would be, it would be an excellent time to meet with you or your team or someone like that. However, they do have to know that in the event that something didn't go 100% right, they may not end up with 100% of those funds. They might have 80% of them, or they might have 150% of them. So that would be my biggest question for them, would be how much risk can they take with those funds?
Janet, that's a great point. And again, everyone's different. Somebody can say, I have the ability to take risk and own US stocks, international stocks. I want to try to participate and start investing in some of these beaten down investments. Others may not have that luxury, and they're going to need to keep that cash in the event things get worse. So you're right. Everything comes down to a personal conversation, and everybody's risk profile is and should be completely different.
Right. So let's see if we have any other questions out there. If you want to chat your question. Tim doesn't see any other questions. Howard, is there something else you would like to show us? I know you had a pyramid that you were going to show us.
Yeah, Carl, if you could bring up that pyramid for us. And so when we sit down with clients and we're trying to build out your portfolio or your financial plan, and again, it's not rocket science, it shouldn't be. So what we do is we make sure you're always going to build the pyramid from the bottom up. So you're going to make sure that you have the safest money, and we call it survival money. So this is money, again, like I mentioned a few minutes ago, to keep the lights on, to pay your obligations. You want to have enough money in that survival before you go to the next level. And the next level would be safety money. So the safety money, maybe you're taking money market accounts, you're doing something a little bit more aggressive with that money. And then as you move up, you're going to see freedom money, gift money, and dream money. So the freedom money this is where you're going to be able to invest it. You're going to be able to make smart decisions and build out a portfolio. And again, to make sure you have enough money on hand to meet those obligations that you may have over the next 3 to 5 years. Now, 5-year plus money would be gift money. This is money that you're kind of thinking in the back of your mind. This is money I'd love to pass on to future generations. And then dream money is exactly what it says. These are kind of to meet all of your dreams. That could be funding a huge vacation for your kids, buying a vacation home, doing things along that nature, paying for education for generations to come. So when you're trying to build that financial pyramid, you just want to make sure that you have the adequate amount of money in each one of these levels. And when we do see it, this should be pretty common sense, but a lot of people have never had this discussion with anybody. The worst thing you can do is put too much money in that dream bucket, and then we see a 25, 30% pullback, and obviously that's going to affect the rest of your pyramid.
Howard, I've got a question coming in. When is the right time that I should be looking at selling my business? Today I'm in business, but tomorrow may change. When would you recommend a good time to exit my investment in my own business, and what should I do with that exiting funding?
So that's a really detailed conversation, Tim. And I know you and Janet have been doing an incredible job with a lot of people having those discussions. Again, it's such a specific conversation to have. I mean, healthcare could drive it. Dreaming about what you want to do in retirement. You and your spouse coming to an agreement that, we've taken this as far as we could go. People looking in their family dynamics and saying that there's nobody really in the family that we can pass this along to. And then usually the business owners that we come into contact with, they know about approximately their exit strategy. And it has a lot to do with what they want the rest of their life to look at. So again, trying to identify the buyers, sometimes it's easy, sometimes it's difficult. The timing can be. You just want to make sure that you're having these conversations with qualified people. I know that's a little bit vague of an answer, Tim, but maybe you and Janet, since you guys have done such a great job, can add on to that.
Perfect. So I see you've come up to a personal financial statement, and I would guess that a lot of people that are on this call have not recently updated a personal financial statement. So Howard, do you want to talk to the importance about having this and what your team does to create this for people?
So Janet, a lot of people either don't have it or they did it once and they really don't update it. This is something that we take a lot of pride in because we want to make sure that our clients understand where they are every step of the way. So these aren't all assets that Raymond James and our team handle, but as you can see, this is a financial statement, a net worth statement for a couple. And when you take a look at the upper left-hand corner and we'll read it downward, you'll see this couple, for example, has a couple accounts at Synovus. They have some taxable investments here in the wife's name. And as you keep reading it through, they have a 401k, they have an ESOP, they have some life insurance. This couple has a business worth a couple $1 million. Rental properties, condos, they have investment real estate, they have a second property in New York. And then you can see some of their personal assets. You'll see boats, motorcycles, jewelry, artwork that's classified there. And just as equally important is if you look on the right-hand side, it's important to keep track of these liabilities. So a couple things very attractive that have happened over the past few months is interest rates on loans, mortgages, second mortgages have come down. So a lot of people aren't paying attention or they're not getting the telephone calls or the communication that they need to look at what interest rate that they're paying. But obviously, when you take an inventory of where you are and you understand where you're going to go, you match those two together and the likelihood of you achieving all of those goals are a lot better. So when you take a look at a personal investment, if you guys or a net worth statement, if you don't have one, you really should start putting one together. This also helps in the event something happens to you, that somebody can simply go down and say, well, mom had an account at Synovus. Mom had life insurance here. Mom had an account at Raymond James. Mom had an annuity that she hasn't looked at, but it's at this company. So this is something that we recommend every single one of our clients have. Some of them are more receptive to it than others, but over the course of our relationship, 95% of our clients will end up with this, and we will work off of this every time that we meet.
Okay, Howard, I got another question came in that I'm sure you've never heard this one before. What is your expectation for the economy over the next year, 5 years? Do you consider us going into an inflationary period or a deflationary period?
That's a great question. And again, it's so difficult to figure out where we are. What I can tell you is we're bullish on where this economy and market goes over the long haul. We have some tremendous challenges and struggles. One of the things we always say, what keeps us up at night? 30 million people unemployed in the United States keep us up at night. Tensions with China and the United States, that's going to keep us up at night. Rioting in the streets, as we've seen over the past 4 or 5 days, that keeps us up at night. So we have to work through these. We've worked through them. But if we take a look at the long-term trajectory of what we believe the markets will look like, our economy will look like, we're positive. Would I say we're overly bullish? Not necessarily. We have to just take a look at where we are. And again, it all boils down to that same, and I know how boring this can sound, is everybody has to, take responsibility for what you own. And if you can upgrade the quality, and I'm not just talking about investments in your portfolio. If you have vacation property, if you have lots and real estate, look for how you can improve it in this market. Maybe you can sell something and replace it with something better. And that's really the evolution of a good portfolio, no matter if it's stocks, bonds, real estate, or cash. So I guess if you're asking me point blank, where do we think this market's headed? I'm a little bit surprised that we've bounced off those March 23rd lows to the tune of about 40%. Typically, we would expect this market to stall out here. And when I say stall out, maybe trade between 23,500 on the Dow and 25,500. That 2,000 point range, that wouldn't surprise me. But are there opportunities? Absolutely. Could this market break down? Sure it could. Now, we're a little bit also concerned about what happens in November with the election, but we've been through all of this before. We've been through every scenario that you can possibly think of. Everyone says, well, this time is different. Well, we don't necessarily believe that it's that different from some of the challenges that we faced over the past 100 years. So again, if you understand what you own and you are liquid and you have high quality, and one of the things that we tell a lot of our clients is you need to be ready. You need to be ready to act in the event some opportunity comes up. And you can't do that if you're not liquid. So that comes to the point where we want clients to have enough cash to get through what they have to get through from their cash flow standpoint, but be ready if an opportunity comes available to say yes. And now that opportunity, Janet, could be a piece of property in Florida somewhere that some distressed seller has to sell. It could be buying Marriott hotel stock at a 50% discount. So everybody's different, but just be liquid and be ready, and you'll be more successful for sure.
Awesome. I think that's pretty much what we wanted to cover today. Just get everybody a perspective on the market and what's really happening in the market. Howard and Carl, I think one of the things that we probably would love to do is do another webinar about how to exit a business. So we'll talk outside of this call, and maybe we could co-sponsor a webinar for people that are interested in moving forward towards getting out of the highs and lows of the economy right now. They're ready to retire. So if anybody has any other questions, let's send them over to Tim in chat and in the Q&A. Howard, any closing remarks for everybody?
I know this is a difficult time, obviously, for a lot of people, but if we take a look at where we are today, and the Dow Jones Industrial Average is off 10%, the S&P 500 is off 5% estimated year to date. So again, if you've been working with a financial professional, you've been here before. The best thing that you can do is just keep this communication going. If you're working with somebody, make sure that they're being proactive and not reactive. We'll get through this. There's always opportunity out there. And again, if we can kind of get anything through today, it's understanding what you own and why you own it. Not why your neighbor owns it, not why your son owns it, not why your friend owns it, but why do you own it? Why is it in the portfolio? Almost like you have to defend it. Why is this particular mutual fund, this particular stock, this particular bond, why is it in my portfolio? And if there's an opportunity to upgrade it, find out what the opportunity is, assess the risk, and then be ready to act.
I'll do the closing.
Howard, that's something that Janet and I talk about often. We always get people call us and say, hey, my friend got more money back on his tax return than we did. We have to say that same thing over and over again. What's the background? What's the details? financial planning and taxes, it might be fun to talk about them on the golf course, but that's not where you should get your advice. So as always, Howard, we enjoy listening to your perspectives, and we generally follow them as close as we can. Every once in a while, we might get a little bit risky, but that's part of the fun of life. And you got to have fun to make it through life. So thanks again for your help. I really appreciate it.
You're welcome. Again, if anybody has any questions, there's my information. Feel free to reach out. And again,
And we are at cpaofflorida.com. If you are not a current client of ours and you want to reach out to us, just go to cpaofflorida.com. And Howard, as a closing remark, Marriott is up $6.58 today. Just thought I'd throw that out there. So.
All right, Janet and Tim, thank you. I appreciate it. And again, if anybody has any questions.
Thank you for your time today, everybody. And we'll look forward to hearing from everyone. Have a great day.
Excellent. Thanks, everybody.